name is Natalie Kreck. I'm a portfolio director at Cazenove Capital, and I was really excited to chair this panel tonight because my job in essence is looking after high net worth individuals and charities and asset allocating between these two different parts of the market. So I had a particular interest in chairing this panel. Before we go around the panel and get everyone to introduce themselves, I thought I would just spend a few minutes on the formatting for Q&A. For those that have attended these sessions before, there's a wonderful Q&A Dropbox, so please do send in your questions and I will monitor them as we go through. We've left about 15 minutes at the end of the session to answer those questions, but if one is particularly relevant to something we're talking about, I will weave it into the presentation. So please do drop in your questions in that Q&A box. Let's go round the panel. Astia, should we start with you? Would you like to introduce yourself?
Yep. Hi, everyone. I'm Astia and representing private markets on the panel. I'm at Eka Ventures, which is a UK seed impact fund, but have spent some time in public equities as well. So started my career at Barclays Investment Bank on the public equity side and moved over into private about a year ago. I'm very excited to be on the panel.
Thanks so much. I'm just going around my screen. Sandra, you're up next.
Thank you. I'm Sandra Robertson. I'm the Chief Executive, so that looks after the business side, but also the Chief Investment Officer of OU Endowment Management. We're regulated business, FCA regulated, and we also have the joy of being classed as an alternative fund manager as well. We manage the Oxford Endowment Fund. It's a £6 billion vehicle. It's for investors that we class as perpetuity investors. There's 45 different investment institutions in the fund. They're all UK charities, and the University of Oxford is the single largest investor. We've got an investment strategy which is very long term. It's global. It's diversified across all assets. So equities, both public and private, credit, property, both directly and indirectly, and other strategies which we bucket or call opportunistic. We're a small business. We're based in Oxford of 26 people. And I started my investment career in 1993, before many of you were even born. And I've seen many cycles of both public and private markets.
Thanks, Sandra. And finally, Alex.
Yes, hi everyone. It's a pleasure to be here. So I'm senior associate on the investment team at Stable Asset Management. And basically what Stable does is it is a one-stop shop for investors who want to launch their asset management firm. And this, we do this across public strategies and private strategies. So this is why I was really interested in joining this panel today. Before joining Stable a couple of years ago, I was working for a family office and responsible for the asset allocation, also across public and private markets. So really selecting managers across both markets. And I started my career as a portfolio manager at a private bank, Degroof Petercam, where I was responsible for investing ultra high net worth individual client money in public markets and also selecting some private equity funds. So I've been across both markets for my whole career and really excited to be here tonight.
Thank you so much, Alex. I'm just going to sort of kick off the sort of line of questioning. Really just let's focus in on private markets to start with. And this is for you, Astia. If you wouldn't mind just explaining what we mean when we're talking about private markets.
Totally. So I think in general, when you're investing, especially within equities, you're buying an equity stake and hoping that you can sell that on in the future for more money than you bought it. Now you can apply that in a private context. So you're buying assets which are not on, I guess, public exchanges and hoping to sell them on in the future for more than you bought them. So within private markets, you have, I guess, three buckets, like three ways of doing private that differ from each other. The first is venture capital, where you're investing in very small companies at the start of their life. The second is private equity, where I guess it's more the mid-market section. The companies are a little bit bigger, a bit more mature. Sometimes they could go onto public markets. Sometimes they're going from public markets into private equity. But that's kind of the second bucket. And then the third bucket is the alternatives. So looking at private debt, real estate, infrastructure. If I spend a little bit of time on venture, just because that's the bucket I sit in, there's stages within that. So you can go anywhere from pre-seed businesses, which are businesses that just have an idea, to seed businesses, which will probably have start generating revenue, Series A, where you're kind of proving your product market fit, and then all the way up into the private equity bucket. So yeah, it's a very interesting space. And I guess we'll talk later on the panel around the growth that we've seen in private markets, but hopefully that's a quick overview of it.
Great, thank you. And then sort of equivalent question for Sandra, what we mean by public markets and the range of things that encompasses.
So I recognise there's a wide variety of knowledge and expertise amongst those participating today. So for those with some knowledge, bear with me. Simply put, I think let's look at the purpose of public markets. Public markets are a way for a company to raise equity capital. We're going to focus on the equity side of public markets. And that's really to raise equity capital across a diverse set of owners, also known as shareholders. Companies often transition from being private, as Estia said, into the public markets. The public markets are still a larger part of the market, capital markets. And they often do this through an initial public offering or an IPO, and you often hear that term used. So their shares are now listed on an exchange, and these exchanges make it very efficient for the owners or shareholders to sell their shares to other investors. And an exchange has a use because these various transactions between buyers and sellers, the prices are collated, and then those are available to other market participants. And then what happens is the number of shares in issue, generally, there are some shares of companies that are not available to public investors, but generally the number of shares in issue times by the most recent price gives the market cap of that company. And those share prices are available for members of the exchange, or they're also available for you to look at websites such as Yahoo. They tend to be delayed on public websites. Investors like ourselves will tend to use what we call Bloomberg terminals for real-time pricing. They're not cheap, so you tend to find professional investors tend to have access to those tools. Each country tends to have its own stock exchange. And they may even have a range of exchanges in a particular country. In the UK, we have the London Stock Exchange. You tend to have larger companies floated or issued or gone to IPO in that exchange. Or we've got a very small cap market, AIM, which really was set about with the equivalent of being what they call in the US, the equivalent to NASDAQ. In the US, you've got the New York Stock Exchange. Again, large established companies tend to trade on that. And NASDAQ has tended to be the home for companies that maybe have come out of Estia's portfolio that have gone to IPO, but they're younger, much faster growing. They actually have less requirements to be taken to these exchanges. So that is where these younger companies tend to go. It's not exclusive. Some companies are large enough to be floated on what we call the bigger exchanges or the main exchanges. The types of investors in public markets really do range from people like ourselves, who tend to be retail investors. I'm not sure any of us yet are high net worth investors, or institutions, and they'll all have different reasons for owning shares in companies, but in general they're owning equities or shares to gain from the success of the business. And that can either be from the company's success in growing, very fast revenues, increases profits, or you may actually be a different type of investor and very much focused on the income that you can get from that company through a dividend, very fast-growing companies. A good example is Amazon. They've tended to reinvest their profits. They haven't tended to give that out in cash to their investors. But some companies, traditionally utility companies, tend to pay out their dividends. And so it depends what individual investors or institutional investors are focused on. There's a lot of strategies within public markets. You can be a public manager and focus just in the UK or just in the US. You can focus on a particular sector. You can be a technology investor and really focus on that. We have 2 funds who focus just in the biotech sector. You need very specific skill set and expertise to invest in that sector. You've got to be part finance, part scientist, I think, to be very successful in that area. Some people focus on investing in a particular size of company. So a little bit like Estia explained, in venture, perhaps in the public markets would be small cap companies. Then you've got mid cap companies, and then you've got the very large companies like Microsoft, Google as well. Different styles for different types of investors, different types of equity managers. There's different ways to invest. Some people invest to try and get exposure to the whole market. They don't really care which companies they invest in. They would just want exposure to the whole of the equity market. They tend to be known as index investors or passive investors. And then you have people we would all call active investors, who really take their time to choose the companies they want to invest in. And there's different ways to do that. You can have investors who are looking for a relative return or trying to outperform an index. So they take the market and they say, I want to make 2% more. As you read the financial literature, you'll see these horrible Greeks creep in. So people will say, I'm looking to generate alpha. All that means is they're trying to outperform the market. It's not any more complicated than that. Or you have some managers, and they tend to be the types of managers we invest in, who are very much focused on achieving an absolute real return. They're looking to invest in the shares of a company for an upside of anywhere between 15 to 25%, depending on what they feel the risks are in that individual company. So really, I want to leave you with this idea. There's no one way to invest in public markets. As you're thinking of your career in financial markets, there's such a different range of ways to invest in public markets. And there's one other thing just to touch on before I hand over, is to say that some public market investors are very short term. So they're focused on what markets will do in the next month, quarter, or year. And some managers are really focused on what this business is going to do over a 3 to 5 year time horizon. They're really not bothered by the day-to-day fluctuations and noise that does tend to happen, much more so in public markets than private markets. So I will hand over now, Natalie. Sorry, I've gone on a little bit.
No, not at all, and all really, really important points. And actually, I want to come back to you, Sandra, to pick up on a word that you used just then on absolute return. And I'm sure some of our listeners will have heard of hedge funds in some of their reading, or potentially in what they'd like to go into as a career path. Are hedge funds something that you utilize in your strategies, and how do you use them, and what's their role that they play within asset allocation?
So there's a whole set of different approaches, as you would expect, for hedge funds. I would say that hedge funds are not actually an asset class. What they tend to be is a legal structure. So they tend to be, but more and more hedge funds have done publicly traded vehicles. But on the equity side, the most typical hedge fund strategy is a manager who will both buy shares of companies and sell shares of companies. Technically, there's a lot on the YouTube about how they actually sell companies, shorting. There's some great literature out there, so I won't spend time with that. But essentially, people are looking to benefit from deep research, and in the research, they tend to find companies they really want to own, but they will also find companies that are doing terribly, and they say, okay, well, let's short this company. Those managers tend to put these two different types of strategies together, but they will typically be what we call net long to the market. So they will typically have exposure to the equity market fluctuations. Many people, Natalie, you rightly say, use them in their portfolio because although they have exposure to the overall market, they don't have as much exposure. So people are hoping to benefit when certain companies go up and when certain companies go down in price. And overall, if you have the right secret sauce and risk control, you can make a pretty constant return from making money from both ways. It's quite challenging, but there are a few groups out there who can do it well.
Thanks so much, Sandra. Before I come on to Alex, I will let Alex have a word in a minute. But SD, I just wanted to know if you could sort of explain to our listeners what a sort of a day in the life of an early VC investor, what that looks like.
Totally. So I guess just jumping on what Sandra was saying around doing deep research, I think all investors, no matter the asset class, will always, do some element of research. And that's definitely how I start my day. So the first half of my day is essentially doing market deep dives. So say that we're really interested in, I work in the impact space, so really interested in carbon capture. I'd like to, meet 100 companies. How do I find those companies? Is it LinkedIn? Is it Dealroom? Is it PitchBook? So that's kind of in the deep work bracket. We also spend a lot of time doing quantitative sourcing. So the way that you would find companies in public markets is, going on Bloomberg, and there's only a finite number of companies on those public exchanges. There's a lot on the private side. So just trying to go through all of that data and seeing which ones are worth speaking to takes up a lot of time. So that's kind of my morning or my daytime job. I'd say what makes private and venture specifically quite unique is that the evenings are quite packed with a lot of networking. So the way that you would buy and sell stocks on public exchanges is that you'd essentially call Mrs. Broker or Mrs. Trader and say, hey, I'd like to buy this much of Amazon for this much price. Can you kind of make that deal happen? In private markets, we don't have those exchanges. So how do you find deals and how do you actually action going long or going short? You have to have a pretty good network of other investors that you can kind of essentially gossip with and see who's doing what deal. Is it exciting? Are they smart? Did they spend their morning doing even better research than you? And actually you should learn something from them. So that's where I guess private is a bit unique, because you'll spend more of your evenings doing as much of the valuable stuff, but just in a very, very different context. And usually this is over drinks or over dinner, or if you're feeling special, they usually have a couple of conferences twice a year where they fly you out to places like Finland. And essentially it's a week of networking, which is fun, but is also quite intense. And I guess to compare and contrast, back when I was on the public side, the hours would be slightly longer within public equities. So I would start my day at maybe 6 a.m. till 6 p.m. So it's more front loading. Whereas in private, I found that you start a little bit later, maybe closer to 9, and finish a little bit later because of that networking piece. But that's kind of a broad brush of my day in the life.
Thanks so much. Alex, get you to join the conversation, because obviously you sit on, I'd say, both sides of the fences, allocating between the two. How do you think about choosing where to allocate money between private and public markets?
Sure. So so I select strategies and managers across public markets and private markets. I think, it mostly depends on what our clients are looking for. Some clients are eager to take a bit more illiquidity and be invested in private markets, and some are looking to invest in public markets, which are relatively liquid. What I would say is that it's a very different approach to selecting public managers. So I'm meaning mostly hedge funds and active managers, than selecting private market-focused managers. There's maybe one similarity where we're always trying to find managers with expertise. So an edge, as Sandra was saying, you know, their quality of research and their ability to really understand companies. So we will try to find, you know, how they analyze companies, where do they get their contrarian view that's different from other investors, where can they make a difference on that front. And then what differs though is, I think on the public side, I think you're really looking for managers who are much more, well, they need to have that sector expertise or that ability to understand the companies, but also they need to understand, you know, how to manage risk and the volatility within public markets. So really like take advantage of all the price fluctuations that you have in the public markets that you have less in private markets because they're not traded at like real time. On the private side, and I would say also on the public strategies, you're asking less of an active investment from the managers. Apart from activist investors, the hedge fund managers tend to be less engaged with companies versus private equity investors or private debt investors that tend to be much more active with companies. So yeah, so they really tend to potentially add value to the companies, really engage with management, try to change things and improve the company's situation. So I would, when I'm looking at a private equity manager, a private debt manager, what I really want to find is a manager that has, you know, an edge in terms of how they add value to the company. Do they have a strong network to help out the company with hiring talent potentially, or helping them out on the operational front? And I would also, you know, be careful in terms of sourcing. In public markets, it's easy. You can buy a company on the market, right? In private, it's much more fragmented in terms of how you get access to these companies. As Jess said, there's much more networking going on, and you have to be spending time with people to understand who's important in a company, who will sell or buy a company, who's leaving, etc. So you have to spend a lot of time on sourcing and networking. And I think the best investors are the ones who have the best networks to be able to add the most value and to you know, have the best sourcing ideas, the best investments, and the best exit strategies, etc. So that's maybe the differences I would say between public strategies and private and public. Yeah.
Thanks so much. Sandra, would you mind if I just came to you on a question? And that's on the point around, I suppose, engagement with companies and how you potentially approach this in things like voting at AGMs and how you look on the engagement side of things with public equities.
Yeah, so we invest through managers. Our managers tend to own anywhere between 10 and 30 individual investments. They view themselves as owners of businesses. So this is on the public side. They do tend to be very engaged with the management teams that they that own the businesses. And they're very active owners of the businesses. We don't, none of our managers outsource their voting. They tend to have discussions with the management teams because they're well informed and understand the businesses that they own. And I think that's super important. You know, you do have a lot of public market investors. They don't tend to be, they tend to be more private organizations as perhaps owned by listed asset managers or large asset managers who have, I would say, a different type of dialogue with the management teams. Obviously no information shared with that, but I think you're going to have a much better and well-informed discussion with somebody if you can demonstrate you understand their business and their industries they're in. So we expect people to be very active owners of the businesses that they own, publicly or privately.
Thanks, Sandra. Could I just come on now to Estia in terms of if we bring things sort of to the market environment now, and obviously last year was a little bit tricky, but would you possibly mind making some comments on some of the trends that we've seen in private markets? And obviously around the fact that 2021 was quite an outlier in terms of fundraising, etc. But if there's any comments you could make just around trends that you've seen within venture capital.
Totally. And just before I go on to that, I'm just going to pick up on what Sandra and Alex said about engagement, because I realized I didn't kind of flesh that out as much in the intro. I guess we're also, so when we invest in companies at the private stage, because they're smaller, you can afford to own more of the company, given that it's broadly cheaper. So when we invest, we tend to own maybe 10 to 30% of a company, which is more than you would have, say, with even the biggest institutional managers like BlackRock and Capital Group. They've got limits of about 10%. So they theoretically can't own more than 10% of Meta or Amazon. And that becomes important at the private side because you essentially get to sit on the boards and have input on strategic decisions. So it's not just how much money can I give to the startup, it's also how much value can I add by sitting on a board, by introducing them to other talent. We also kind of play, we also play recruiter for a lot of our portfolio companies. So it's a bit more of a consulting role than purely financial. But yeah, to go back to the trends question, because I think it's really interesting at the moment. If you guys will have been reading the news, private equity raised a lot of money during COVID. And that's essentially because if you think about where you want to invest your money to get the highest return, you're coming out of a decade or so where interest rates were very low, which meant that investing in public debt maybe wasn't the best idea for you if you wanted higher returns, which is why private equity became super exciting, because on top of getting your interest rate return, you also get a return because the investments are illiquid. That's called an illiquidity premium. Now, in that low interest rate environment in the last 3 years, private equity fundraising basically grew 3x. And that's a positive for the industry because we have a lot of money to deploy. It's also a little bit of a stressor because you have to deploy that money within maybe a 5-year time period, which means you're now pressured to spend when the macro environment is becoming much slower. So there's this kind of tension of like, do you deploy now? Do you hold back? If you hold back too much, your own investors are going to get scared. And I don't have a perfect answer for that, but I think it's a really, really interesting debate within privates at the moment. I have one more thing on that. I think on the venture side as well, we should remember that the purpose of venture is to kind of start that business ecosystem. You're right at the start, you're kind of funding the companies of 2050. So you also need to keep deploying in order to keep that ecosystem alive. So more questions than answers, but I think it's a really interesting space for the next 5 years.
Thank you. And I just wanted to pick up on that expression you talked about, the illiquidity, and that's obviously one of the key differentials between private investing and public. Is there's in private investing your money is tied up for potentially quite long periods of time. Obviously that's a key reason why, going back to Sandra's point about the types of investors, the retail investors that easily access public markets, but do you see that as a trend shifting at all? And I can make some comments from my side as well.
So do you mean specifically around people liking illiquidity less?
The types of investors that can gain access to your strategies, basically.
Got it. Yeah, absolutely. So traditionally, the way that VC came about was it was a lot of really rich families out of the US in the 1960s and 1970s that were like, we really want to fund like pipe dreams. And that was really exciting because you'd never had that much money available, but it was also incredibly exclusive, right? Because you or I would have had to have a lot of money already in our bank in order to even access this. So with my ICA VC hat on, we think that you do need specialized experience in order to invest in VC. On the flip side, I'm really encouraged by a lot of startups now that are trying to democratize access so that retail investors could have almost more of an, Sandra was talking about indexing. If you could have kind of bite-sized VC chunks that are worth £100, £1,000, obviously really, really risky investments. But at least it makes the asset class way more accessible to retail investors that previously didn't even have the choice to opt in.
And I think just from where I sit, I completely echo those comments. So as I mentioned at the beginning, I look after high net worth individuals, private client money and charities who wouldn't be able to write the ticket sizes historically you've needed to access this asset class. But, with the rise of technology, we're seeing that democratization really play out. And we are today able to give access to the types of markets that you invest in for our clients when previously that was shut off for them. So I think that's quite an exciting development for clients to be able to get access to these opportunities. Can I go back to Sandra? Would you possibly be able to, this is a really open-ended question and we could be here all day answering this, but a sort of an outlook for public markets at the start of 2023 and how potentially this is influencing your stock picking or where you're looking at opportunities?
I think it's important to put everything in context. I think we've had a 15-year, what we would call bull market. So a very strong market for equities. I think you have to understand where that's come from. There's been a mix of incredible innovation. Some of the technology companies, of course, had fantastic business models, still have fantastic business models, some of them. I think that interest rates have been very low for that period of time. And people might say, well, how does that impact public markets? Well, what it does is it takes money perhaps away from areas that would have been more attractive in a higher interest rate environment, allows people to borrow to invest. So there's been a lot of liquidity in the market and it's been cheap to invest. You saw 2020, 2021, you would think the markets would have gone down with the global pandemic. Central banks and government initiatives flooded the market with even more liquidity, so we had two incredibly strong years. I think that 2022 was a mild correction. It was a strong correction, particularly for technology, which I think had some very fruity and unrealistic valuations, let's just say. And I think those are coming off. I think if you're sitting today looking at markets, I think you have to understand that just simply having exposure to everything in the market, so indexation has worked over the last 15 years because of arguably cheap money. Today, businesses are struggling with higher energy costs, higher labor costs, and higher borrowing costs. I think that you've really got to know and understand what you're investing in. You've got to look out 5 to 10 years to say these businesses going to exist in 5 to 10 years' time. Everything is changing so rapidly as well. So I don't ever predict what the markets are going to do. I think for those of you who are interested in investing in this, in overall, there's a chap called Howard Marks. He works for Oaktree Capital. He writes great letters. They are very readable for you. And he has a fantastic one on the value of predicting markets. And so I would say I have no idea what's going to happen with public markets, but I think investors are grappling with a whole range of issues that they have not faced before. And I think it's going to make for a very interesting environment, and particularly I'm biased, of course, but I think it'll be a really good environment for people that do the research and are patient.
Thanks, Sandra. And Alex, if I could sort of ask you a similar question, just in terms of what you're thinking about, and then also from sort of asset allocation decisions as well.
Yeah, I think I completely echo Sandra's point of, I would really be worried of ETF investing and, passive investing, although this is what has been very strong over the past 15 years. I would really focus on managers who do very intense research, know their companies, and who are great stock pickers. yes, really managers who do the work and who are patient. Across the managers and strategies we're looking at and interested in, I would say in the hedge fund space, we have really focused on managers with lower net exposure, so who can pick both long companies and also short bad companies. So taking advantage of potential companies that will not exist in a couple of years' time. And also, I mean, to come to credit and higher interest rates, I think there has been, I mean, there's a growing opportunity set in credit rather than equities, with potentially lower risks than in equities. So this could be interesting as well. So, and in terms of on the private side, what I would say is, yeah, I mean, given higher interest rates, I think a lot of private credit strategies make sense. And strategies, I mean, with the whole energy transition coming through and, you know, need for like essential infrastructure to be built to deal with climate change and, you know, just really the lack of modern infrastructure out there. I think I would think infrastructure is a great place to be invested in. Yeah, so we are putting a big push on infrastructure right now.
And you slightly stolen my next question, Alex, but I'm going to pass this over to Esther about that bit about the energy transition. And obviously, since, you know, the war is, I can't believe it's almost been a year going on since the invasion of Ukraine by Russia. Mm-hmm. And I think it's really focused everyone's minds about the need to really think about the energy transition. And Esther, something you mentioned earlier about your focus on impact and in VC. Are you seeing opportunities to invest in companies that are really focused on this energy transition in terms of technologies they're looking at, etc.?
Yes, absolutely, 100%. So enthusiastic about it. I think also what's the short answer is yes, but you need to think about what solutions are relevant for which capital classes. So within VC, remember, we're funding small solutions or, you know, things at the start of the hype curve. So that could be heat pumps, it could be batteries, it could be EV, you know, public charging. Crucially, what it isn't is kind of what Alex was saying. It's the big public infrastructure projects which need capital, but they need more than VC capital. That's more in the infra bucket, or sometimes it's within, you know, private equity bucket. So within that, we'd have, you know, solar PV, the technology is pretty much there. Same with wind farms. What isn't there is the scale, which is why you need more capital to allocate. And then I guess within the UK context, the big question VCs within the impact space are asking is, what does the energy grid look like from a structural point of view in 2050? Are we still going to be relying on coal? How much are we going to be relying on wind? And then if you back solve from that, what startups do we need to be funding today in order to kind of equal that in 2050? So definitely a space we're really, really keen on. I guess to link it back earlier, a lot of fundraising came into this space in 21 and 22, which is why on the flip side, it's also kind of teetering. People are talking about a climate tech bubble 2.0, which we think has some merit because of the funding levels. But I think in the grand scheme of things, bubbles are only bubbles if, you know, the steady state is lower than the bubble. By that, you know, there can be overvaluations, but in the long term, you can still make money. So it's a space we're really keen on. There's been a lot of money going in, but we still think there's opportunities there for sure.
I think across the value chain, it really makes sense on the private side to be focusing on, you know, infrastructure technology, as you were mentioning, Esther, and then going through the larger projects, and which can be led by public companies actually. And what's interesting, maybe to echo on, you know, the active management piece and the overfunding of some sectors, is that in the public markets, you can actually see amazing companies, super well run and managed companies, and also companies that are not well managed, very levered. And so you can actually take a strategy. You have a strategy to invest in the potential winners and short the potential losers or not well-run companies. I don't know if you have anything to add, Sandra, but I think there's been so much capital going into this space that there's good and not so good companies.
I think that's, I think that we don't just view it as the energy transition. I think it's a wider issue. I think we've got to look at this whole resource efficiency. It's been a theme of ours for many, many years. It's just not about the energy that we use. It's about the carbon that we're, the carbon that is almost, that is polluting our environment. I think that on the public side, there's a lot of great work going on with the whole net zero. I think that more and more academic research is coming out from that, giving companies proper frameworks to get there on the public side. I think we see incredible innovation in technology, whether it's software or even on the consumer side, new ways of consuming, different ways of consuming, whether it's sharing. We see our foods, a lot of great innovations in the whole agri-tech space. Let's use less of the planet's resources, and what we use, let's use it really well. So I don't think it's just necessarily about specific sectors. What I would say is that you do have to remember that every part of the investment chain has different risk rewards. Venture is really exciting, but there's really not that many companies that do well in venture. There's a lot of unicorns the last 2 years, but it does matter what you pay for a business. I think that, but with venture, we invest in venture. I've been a big investor in venture all of my institutional career. You do it with the expectation that there'll be a lot of losses, but those 2 or 3 winners are going to be spectacular. By the time you get to the public markets, you don't expect the same loss ratio as you do in the venture markets. But it's really crucial that we do still put money into innovation and that part of the market. But there's always, people always get overexcited and overpay. It's just market cycles. But the best companies that come out are the companies that get through the tough times. Great management teams, innovative management teams, and deep pockets around the table. So, I'm optimistic. I think humans will solve this over time.
On that agro tech point, this is completely new to me, but has been around for a while. One of my colleagues was lucky enough to visit a vertical farming factory, which was something I had never heard of before. But as you say, Sandra, I think we have the innovation to come up with these solutions for so many of the problems we face, which is really, really encouraging. If I could ask you all, I think this is a bit of a mean question to ask you all, and then I'll move on to the Q&A because I've seen a couple of questions come through. I'd love for you to share with our audience what you believe in your area that you operate in. What is a key sort of differentiating skill set to add that edge, or to a Greek alphabet? Sandra was referencing earlier how you add alpha for your clients. So Esther, should we start with you?
Yeah, so I think I've mentioned both of these implicitly previously. The first is you need to be pretty good at socializing and knowing how to, curate your network, keep in touch with people that you think are really helpful. Likewise, be quite good at being a little bit more systematic around how you're spending your time in the evenings. So I think that's definitely something I'm learning as I'm going through it. The second is around learning quickly. So I think this is probably an unfair comment to say it's just within VC. Everyone needs to be really smart and learn quickly. But when you're dealing within private markets, a lot of the time you have an information disadvantage. What I mean by that is you don't really have a lot of numbers, for example, with like revenue figures or gross profit, because the company hasn't existed for more than a year. So you need to learn about what the potential for that startup is. Is it going to make you money? Sandra said it's really hard to kind of blow out and make really good money in ventures. So there's a concept that we call returning the fund, whereby out of, call it 20 investments, only one will really make you money. So you're essentially losing money on 19, making money on one. But that doesn't mean you're allowed to be, quote unquote, dumb on the 19. You need to kind of spread your time. So maybe it all rolls up into time management. So how do you spend your time socializing, making sure that's value add? How do you spend your time, building expertise in the market, and ultimately make better investment decisions?
I think I could ask, we are focused on venture, but specialized in investment managers, right? So building the investment firms of tomorrow. So I would echo a lot of Estia's points, which is, how to best spend your time and how to fail fast, understand which managers will be great investments and which ones will not, and be able to screen, have an eye for great investors and ones that aren't, who just don't make the cut. And there are not that many great investors out there.
And the question over to Sandra.
I think for a pool of capital like ours, who invests money for institutions that want to be around, not only for the next 10, 15 years, but the next 50, 100, and in the University of Oxford's case, the next 1,000 years. I think for us, the duration of our capital is a clear competitive advantage. It does make investing in strategies with venture where you need to, individuals are welcome to invest, but you've got to have a 10, 15-year time horizon. The last 5 years are not representative overall of really venture capital. We've had an unusual period in venture capital. So it allows us to invest in strategies which have a very long duration, and I think that gives us the competitive advantage. And then, Alex, I couldn't agree more with you. Really, there aren't that many great investors in the world, and a lot of our job is to go out and find them, hopefully at an early stage. And you know what? The great investors absolutely control who they want to manage money for. So our brand, our investor, that really does help us to access those managers. A lot of those managers really, they don't turn up in Oxford. We've got to go out and find them in obscure locations around the world. So I think our global view and our brand gives us access to find the investment talent that really can make a difference.
This is probably a sort of, I suppose, not a divisive question for Sandra, and even actually for Estia and for Alex, about allocating money to places like China. And we've talked briefly about sustainability and impact and ESG. Would you mind sharing your views on allocating to markets like China? Sandra, should we start with you?
I think you have to look at the facts in China and also what people are doing in China. Some of the ESG reporting in China, the carbon reporting, is actually way ahead of some Western markets. So I think that don't rely on the Western press for your information. I would say do your own proprietary research and get to the facts, not speculation. I think in every country there's well-managed businesses. What I would say that we have seen in China is phenomenal amounts of money going into research on resource efficiency. They have an energy policy. They have a policy to take them from where they are today into the future. I think that it's very hard to generalize. I think certainly the political risk in China increased last year. But I think you've got to do it on a company by company basis, management team by management team basis.
Yeah, I think I would agree. It's really, you really have to be selective on the managers that you back. And here again, I think it is really essential for the managers that you invest in, that they have the ability to read regulation and politics, which is like, leading the markets in a way. But I mean, we have invested, and it's not an easy task. I would say you really have to find managers that are on the ground, actually verifying everything that the companies are doing. And there are great companies out there, really, but just there are also bad ones. So you really have to take the bar super high up. in that market. But I have to say, I mean, well, we like to focus on inefficient markets where you can make the most alpha, where information is not flowing efficiently and easily for everyone to see. So this is also where you can potentially make the most capital gains, right? There's just a lot of risk involved.
Yeah, and I suppose position sizing accordingly,
Yes.
with factoring in all of those risk factors as well.
Exactly, yeah.
And if I can just jump in there, so we're UK only investors, so we tend to, if we were to invest in China, it would be, you know, UK headquartered company generating a lot of revenue here, but with some China exposure. And we do have one of them in our portfolio. As an impact investor, it's been really interesting to kind of understand how you can shift the market. Because I guess one thing is underwriting geopolitical risk within China. The other is underwriting impact risk. And there, from an impact investor perspective, there's huge opportunities in terms of how you rationalize the supply chain, how you add in verification elements. Just because it's China doesn't mean we shouldn't be looking for value either. So for us, that's been a really positive opportunity, but definitely not our bread and butter investment for sure.
Yeah. One of the things I hadn't quite ever appreciated, going back to our discussion about the energy transition, is the amount of solar panels, everything, the manufacturing that is done in China. So I thought that was quite interesting. It goes back to Sandra's point as well about their policies around energy transition, etc. I think we've got a few more minutes left. There's a couple of questions, and we may have sort of already answered one. It was a question about, are startups on food innovation a potentially good investment? We sort of commented on that a little bit, but if anyone has anything additional to add.
I've been doing a lot of research on the space, so I'm happy to kind of give a quick high-level overview. And again, this is from an impact perspective, so not only looking for financial return. When you look at the amount of capital that's gone into food innovation, specifically alternative protein, you'd hope that essentially the way that you gauge impact on that is by looking at decreased meat consumption, because the thesis is, as you offer more soy products or vegan cheeses or lab-grown meats, you would see a decrease in dairy and, you know, cattle farming. The problem is you haven't seen that in line with what you'd expect following the funding. That's not to say it's a bad investment. It's just to say we need to be a little bit smarter around how we, I guess, define value and how you think about impact going forward. But there's a lot of work and a lot of startups that I speak to specifically within lab-grown meats that we find really exciting. It's just we don't have a strong view on which horse to bet on for the next 5 years.
And then the other question that's popped up, which actually quite a few of you mentioned, and I'll actually pass this to Alex, because you've mentioned it quite a few times, about shorting a company, and actually equally, how do you short a private company?
Oh, so you cannot actually short a private company. Well, I mean, yeah, so you cannot do that.
No, I think
you can. Technically, the reason you can't short it is because you need a very liquid market. You need people that are buying and selling things very quickly so that you can kind of make the difference. You could thematically, and this isn't a good answer, but you could thematically short a private company. If you were to say, like, there's this really big private company, don't think it's going to do well, I could maybe buy like a public equivalent. That's a very, very loose way, but you can't, essentially the mechanisms aren't in place. There's not enough liquidity.
Yep.
I'm just going to check if there's any more Q&A. There's nothing at the minute. I think what we'll do is it's approaching 7 o'clock. I will be passing back to Vicky, but I would just like to say thank you so much to our panelists. That was really interesting, and hopefully everyone online found that really, really helpful. I will pass back to Vicky now.
Thank you, Natalie. I want to echo what you just said and say thank you to all of you for an incredible panel, an incredible discussion, and sharing your knowledge and your wealth of experience with our students. We really appreciate it, and there has been it's been a really interesting discussion. What we're going to try and do going forward is have some highlights, short video reels as well as the large, the entire video, which is always going to be on our website. So if anybody wants to refer back to it, it will always be there. But thank you also for being here. Thank you for listening. Thank you for paying attention, for your interesting questions. And please do follow us, go to our website, see what we've got coming up. This is only the first of, I think, 8 or 9 events we've got coming up this spring. It's www.gainuk.org. And we're also on social media. So Girls Are Investors on Instagram and just Are Investors on Twitter. Hope to see you at some of the other panels. And thank you so much to our panelists again. Please do come back on and do this again with us, because that was a really great session. Thank you all. Have a good day.
Thank you.
Thank you.
Bye.
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 Bye.